The venture capitalist dismissed my pitch before I finished. Women are biologically risk-averse. You'll never make it in high-stakes venture capital. I was 32 with my entire savings on the line. 8 years later, my fund returned 500% while his firm went bankrupt. When he asked to invest in my fund, I told him he was too risky. But let me start from the beginning. My name is Chen, and I'm 40 years old. I grew up in the San Francisco Bay Area, daughter of immigrants who believed in education, hard work, and playing it safe. My mother, Jessica, was a CPA. My father, David, was a software engineer. They saved every penny so I could go to a good university. I went to one of the top schools and studied economics, then business school. I graduated with honors, with a mountain of debt, and with absolutely no idea what I really wanted to do. Everyone told me to go into consulting or banking, safe, prestigious, good salary. But I was drawn to something else. Venture capital. The idea fascinated me. Finding companies when they were tiny, believing in them, helping them grow, and potentially making massive returns. It seemed like the perfect combination of analysis, intuition, and impact. At 28, I got my first job at a venture capital firm. Not a top-tier one, but respected. Mid-size, 30 people, several $1 billion under management. I was hired as an analyst, the lowest rung. My job was to read pitch decks, do financial models, research markets, and support the partners who made the actual decisions. I was one of 3 women in the entire firm, the only Asian woman. The first 6 months, I kept my head down and worked, 80-hour weeks, reading hundreds of pitch decks, learning the industry, learning the language, how VCs think, how they evaluate companies, what they look for in founders. I started noticing patterns. The partners had types. They liked founders who reminded them of themselves. Young white men from good schools who were confident, articulate, and came with warm introductions. If a founder didn't fit that pattern, they faced more skepticism. More questions, higher bars. In my first year, I watched 100 pitches. I saw brilliant founders get passed on because they didn't fit the pattern. Women, minorities, first-time founders, people with accents, people who were too quiet or too intense. Meanwhile, mediocre founders who fit the pattern got funded. I started speaking up in meetings. In one pitch meeting, a founder was presenting a financial software company. The numbers looked off to me. The revenue projections were too aggressive. The customer acquisition costs didn't make sense. I raised my hand. I think we should be cautious here. The unit economics don't work at scale. The senior partner barely looked at me. Morgan, you're still learning. Trust us, we've seen thousands of these. They invested $2 million. 18 months later, the company went bankrupt. My analysis had been correct. But nobody remembered that I'd flagged it. Another time, an AI startup pitched us. I was excited. The technology was early, but the team was brilliant. The market opportunity was massive. I did deep research and prepared a 20-page memo recommending we invest. The partners passed. Too early. Too risky. Not proven yet. 3 years later, that company was valued at over $1 billion. Another firm had taken the risk. Again, I'd been right. Again, it didn't matter. By year 2, I was frustrated. I had good instincts. I could spot opportunities, but I was invisible. When I spoke in meetings, people talked over me. When I shared ideas, they were dismissed, only to be repeated by a male colleague 10 minutes later and praised. I thought about quitting. But I also couldn't let go of the belief that I could do this, that I could be good at this. At 30, I made a decision. If I was going to succeed in venture capital, I needed to do it on my own terms. I started planning to launch my own fund. Starting a venture capital fund is not easy. You need money, a lot of money, not just your own money to invest, but money from other investors, called limited partners or LPs. These are wealthy individuals, family offices, pension funds, endowments. They give you money to invest on their behalf. But getting LPs when you're a first-time fund manager is nearly impossible. They want track record. They want proof. They want connections. I had none of those things. What I did have was 4 years of experience analyzing companies, a thesis I believed in, and my entire savings, $250,000. It wasn't much in venture capital terms, but it was everything I had. My thesis was simple. Overlooked founders. Oversized returns. I believed that the venture capital industry had massive blind spots. By only funding one type of founder, VCs were missing huge opportunities. If I specifically invested in the founders that others overlooked, women, people of color, immigrants, first-time founders, I could find better companies at better valuations and generate higher returns. I had data to support this. Studies showed that diverse founding teams actually performed better, that female founders generated higher revenue per dollar invested, that the industry's bias wasn't just wrong morally, it was expensive financially. I spent 6 months preparing, building financial models, researching markets, creating presentations. I started reaching out to potential LPs, people I'd met through work, alumni networks, friends of friends. The first 50 meetings went nowhere. You're too young. You don't have a track record. First-time fund managers are too risky. Why would we bet on you when we can invest in established firms? Every rejection hurt, but I kept going. Then I had a meeting that changed everything, or so I thought. Richard Thornton was a legend in venture capital. He'd been in the industry for 30 years. His firm, one of the most respected, had backed some of the biggest companies in tech. He was wealthy, connected, and influential. If Richard invested in your fund, other LPs would follow. Doors would open. Getting a meeting with him felt like a miracle. A mutual connection had made an introduction. Richard had agreed to hear my pitch. I prepared for 2 weeks. I refined every slide. I rehearsed every line. This was my shot. The meeting was at his office, downtown, 50th floor. Glass walls, mahogany desk, art on the walls, the kind of office that screamed success. Richard sat behind his desk, mid-50s, expensive suit, confident. He barely looked up when I entered. Morgan Chen? Yes. Thank you so much for taking the time to meet with me. Let's hear it. I've got another meeting in 30 minutes. I launched into my pitch. I showed him my thesis, the data on overlooked founders, the market opportunity, the potential returns, my background, my analysis, my plan. 20 minutes. I gave it everything. When I finished, Richard leaned back in his chair. He was silent for a moment. Then he smiled. Not a warm smile. A condescending one. Morgan, right? Let me be honest with you because nobody else will. My stomach dropped. I respect the hustle. Good school. Business degree. You're clearly smart, but venture capital isn't for everyone. I believe I have. He held up his hand. Let me finish. Here's the thing about venture capital. It's about taking risks. Big risks. High stakes. You win big or you lose big. And women? He paused. Women are biologically risk-averse. It's not your fault. It's evolution. Women had to protect children, be cautious, avoid danger. Men evolved to hunt, to take risks, to gamble. I felt like I'd been punched. You can fight biology all you want, but you can't change it. Women in venture capital tend to pick safe companies. Boring companies. They underperform. I've seen it again and again. That's not... I started. You'll never make it in high-stakes venture capital. My advice? Try private equity. Steady returns. Predictable. Or maybe corporate finance. Something more suited to your temperament. He stood up. The meeting was over. Good luck, Morgan. I mean that. I gathered my things. I walked out. I made it to the elevator. The doors closed, and then I couldn't breathe. I stood there, alone in the elevator, and felt everything collapse. 4 years of work, 6 months of preparation, my entire savings, my whole plan, and he'd dismissed it in 5 minutes because of my biology. I made it to my car. I sat in the parking garage and called my best friend Elena. How'd it go? I couldn't speak. I just cried. That night I almost gave up. I sat in my apartment, staring at my computer, at all the spreadsheets and presentations I'd built. At the research, at the dreams, maybe Richard was right. Maybe I was fooling myself. Maybe I should find a safer path. Elena came over. She brought wine and didn't say anything for a while. Just sat with me. Finally, she asked, "What are you going to do?" I don't know. Maybe he's right. Maybe I am too risk-averse. Maybe biology does matter. Elena looked at me. Morgan, do you actually believe that? Or are you letting one sexist old man define you? I didn't answer. Because the Morgan I know isn't risk-averse. The Morgan I know quit a stable job to start this fund. Put her entire savings on the line. That's not risk-averse. That's brave. But what if I fail? Then you fail. But you don't get to say you didn't try. I thought about that all night. About risk, about biology, about who gets to decide what I'm capable of. By morning, I'd made my decision. I was going to start my fund, without Richard, without any LPs, with just my own money. $250,000. It wasn't much, but it was enough to start. I called it Chen Ventures, and I got to work. Running a micro-venture capital fund is lonely. My office was the second bedroom in my apartment. My team was me. My budget was non-existent. I couldn't write big checks like traditional VCs. I could only invest $25,000 to $50,000 per company. Small enough that most VCs wouldn't bother. But I had a thesis. I was looking for founders that others overlooked. Women, immigrants, people of color. First-time founders. I started going to pitch events, demo days, accelerator programs, anywhere I could find early-stage companies. I met brilliant founders who'd been told no 100 times, who'd been dismissed, who'd been told they didn't fit the pattern. I invested in 10 companies that first year, a woman building software for healthcare providers, an immigrant founder creating a language learning app, a Black founder developing AI tools for small businesses, a first-time founder building sustainable fashion supply chain software. 10 companies. All overlooked, all brilliant. The industry thought I was crazy. She's picking losers. Those founders will never scale. It's charity, not venture capital. The first year was brutal. Most of my companies were struggling, which is normal for startups, but it was terrifying when it was my own money. I had doubts. Daily. Was Richard right? Was I making emotional decisions instead of rational ones? Was I too risk-averse to pick real winners? Then, in month 18, something happened. One of my portfolio companies, the healthcare software startup, started getting traction. Real traction. Customers were signing up. Revenue was growing, fast. The founder, Lisa, was brilliant, but had been passed on by every major VC because she was too niche and not ambitious enough. But she'd built something hospitals desperately needed, and now they were paying for it. 18 months after my initial investment, Lisa raised a Series A. $10 million. My $25,000 investment was now worth $500,000, 20 times return. In less than 2 years, then another portfolio company hit, the AI tools for small business. They signed a major partnership. Growth exploded, then another. The language learning app got acquired. $50 million. My $50,000 investment became $2 million, 40 times return. By my third year, something remarkable happened. My initial $250,000 had turned into $5 million, 2,000% return. In venture capital, anything over 3 times return is considered good. I'd returned 20 times. The industry started paying attention. I got calls from angel investors, from people who'd heard about my returns. One of them, James Kim, asked to meet. "Morgan, I want to invest in your next fund." My first limited partner. Fund 2 was different. I raised $15 million, 10 limited partners. Real money. A real fund. I moved into an actual office. I hired my first employee, Priya Patel, a data scientist. We built systems, processes, a methodology. Instead of just instinct, we used data. We analyzed thousands of founders and companies, looking for patterns that predicted success. Not the traditional VC patterns, which were biased, but objective metrics, growth rates, customer retention, revenue efficiency. We found that the things that actually predicted success had nothing to do with the founder's gender, race, or background. They had to do with execution, with how they responded to feedback, how they managed their team, how they thought about their market. Fund 2 was more aggressive. 15 companies, bigger checks, $100,000 to $250,000. Again, I focused on overlooked founders. And again, people were skeptical. But 2 years into Fund 2, my companies were thriving. 3 of them became unicorns, companies valued at over $1 billion. One of my investments, $200,000, was now worth $50 million on paper. My returns were tracking at 1,500%, again, far above industry average. At 37 years old, I wasn't a rising star anymore. I was established. I started getting invited to speak at conferences, to join panels, to advise other funds. The firm that had employed me years ago reached out, asking if I'd consider a partnership role. I declined. I was building something different. By Fund 3, I had real institutional backing. $75 million. Major limited partners. A team of 10 people. A penthouse office with views of the city. The media started covering me. Business publications, podcasts, profiles. The VC who bets on the overlooked. How one woman is changing venture capital. The fund with 500% returns. I gave talks about my methodology, about how bias is expensive, about how if you only invest in one type of founder, you miss 90% of opportunities. The data was undeniable. My Fund 1 had returned 2,000%. Fund 2 was tracking at 1,500%. Fund 3 was off to an even better start. Meanwhile, traditional firms were struggling. The market was tough. Many funds were underperforming. I'd occasionally see news about Richard Thornton's firm. They'd had some bad investments, some failed exits. Limited partners were reportedly unhappy. I felt nothing when I saw those articles. I was too focused on my own work. Then, one day my assistant knocked on my door. "Morgan, you have a meeting request." "From Richard Thornton." I looked up. "What? Richard Thornton?" "He's requesting 30 minutes of your time." It had been 7 years since that meeting in his office. 7 years since he'd told me I was biologically incapable of success. I was curious. I accepted the meeting. Richard came to my office. The roles were completely reversed now. I sat behind the desk. He was the visitor. He'd aged. 7 years had added weight and gray hair and something else. Uncertainty. "Morgan, your office is impressive. Congratulations on your success." "Thank you. What can I do for you, Richard?" He shifted in his seat, uncomfortable. "I'll be direct. My firm is going through some restructuring. The market has been challenging. Our returns haven't been as strong as we'd like." "I'm sorry to hear that. I've been following your funds. Very impressive returns. Really exceptional. And I thought perhaps there might be an opportunity for collaboration." I waited. "I'd like to invest in your next fund as a limited partner. I can bring capital, connections, industry knowledge. I think it could be mutually beneficial." There it was. 7 years ago, he'd told me I'd never make it, that I was biologically programmed to fail. Now his firm was struggling. He was desperate, and he wanted to ride my success. I thought about what to say. Part of me wanted to be cruel, to throw his words back at him, to make him feel what I'd felt. But that wasn't who I was. "Richard, I appreciate you reaching out, but I'm going to have to pass. I understand you have a lot of LP interest, but I can bring unique value. It's not about capacity, it's about alignment. My fund has a specific philosophy. We invest in people who others overlook, and we partner with investors who share that vision. I understand the market is changing. I can adapt. 7 years ago, you told me that women are biologically risk-averse, that I'd never make it in venture capital. Do you remember that conversation?" His face went pale. "You were wrong. Not just about me. About your entire approach. You missed opportunities because of bias, and now your fund is paying the price for that." "Morgan, that was a long time ago. I've learned, I'm sure you have. But here's what I've learned about risk. Real risk isn't investing in different kinds of people. Real risk is only investing in one kind of person, because that's how you miss the next big opportunity." I stood up. "You're too risky for my fund, Richard. Good luck with your restructuring." He stood slowly, nodded, and left. I sat back down, smiled. Justice doesn't always need to be loud. The next year, Fund 3 had its biggest exits. 3 major companies went public or got acquired. An AI company, acquisition for $500 million. My $5 million investment became $125 million, 25 times return. A biotech company, IPO at $800 million valuation. My $3 million investment became $90 million, 30 times return. A fintech company, acquisition for $1.2 billion. My $4 million investment became $200 million, 50 times return. Fund 3, overall return, 500%. One of the top-performing venture capital funds of the decade. Meanwhile, Richard Thornton's firm dissolved. The partners went separate ways. Richard essentially retired. His reputation was damaged. My firm, Chen Ventures, was now a top-tier venture capital fund, $200 million in assets under management, A team of 15, a portfolio of 50 companies. But more importantly, I was changing the industry. Other funds started following my lead, investing more in diverse founders, using data instead of pattern matching. The tide was shifting. I launched a program called First Check. We gave $25,000 to $50,000 plus 6 months of intensive mentorship to first-time founders, specifically women and minorities. The first year, we backed 20 founders. 15 of them went on to raise Series A. At 40 years old, I was invited to give the keynote at a major industry conference. 1,000 people in the audience. My talk was titled, "The Cost of Bias: How Overlooking Diverse Founders Costs Billions." I showed the data. Venture capital firms with all-male partners average 2 times returns. Diverse firms average 3.5 times returns. Every bias is expensive. I saw Richard in the audience. He looked small, diminished. During Q&A, a young woman asked, "How do you handle people who doubt you because of gender?" I thought about my answer carefully. Early in my career, someone told me that women are biologically risk-averse, that I'd never make it in venture capital. For a while, I believed him. But then I realized something. Risk-averse doesn't mean cowardly. It means avoiding unnecessary danger. What he called risk-averse, I call strategic. I didn't take stupid risks. I took calculated risks on people others overlooked. And that strategy returned 500% while his firm went bankrupt. So to answer your question, let them doubt. Your returns will speak louder than their biases. The audience stood and applauded. I looked out at all those faces. Some were young women who reminded me of my younger self. Uncertain, determined, scared but hopeful. I hoped they heard what I was really saying. You can do this. Don't let anyone tell you otherwise. I'm 40 years old now, preparing to launch Fund 4, $500 million. My biggest fund yet. The industry has changed. Not completely, but noticeably. More diverse founders are getting funded. More diverse investors are starting funds. I'd like to think I played a small part in that shift. Richard Thornton reached out one more time, a few months ago. An email, brief. "Morgan, I wanted to apologize for what I said years ago. I was wrong. Your success proves that. Congratulations. I read it. I didn't respond." Some things don't need a response. Yesterday, a young woman reached out on social media. "I'm trying to break into venture capital. Everyone says it's impossible for women. How did you do it?" I replied, "They're wrong. It's not impossible. It's harder. But harder doesn't mean impossible. Start small. Prove them wrong with returns. Numbers don't lie. Good luck." She responded immediately. "Thank you." That's all I needed to hear. I smiled, because that's the legacy I want. Not just the returns, not just the successful companies, but the doors opened. The next generation believing they can do it too. Last night, I found an old notebook from 8 years ago, right after that meeting with Richard. I'd written one sentence. He said biology determines destiny. I'll prove that choice does. I closed the notebook. I proved it, not with anger, not with revenge, but with returns, with data, with results. Because in the end, that's what matters in venture capital. Not who you are, but what you can deliver. And I delivered 500% while being exactly who I am. Sometimes the best revenge isn't destruction. It's success, and not caring at all.